is there even a right age to enroll for NPS? I know that I'm late, but that's because, I haven't had a salary job for a very long period of time. But if I had, then I would have done this. I got in too late. I'm 51 right now.
Right.
Okay. I thought I'm ideal any which way.
Right.
Okay. But other than me, who do you think, what's the right age to get into this?
So I'm going to talk about, again, I'm going to use some numbers, and I don't want to sort of, make it very confusing, right? If you look at somebody who started investing in, let's say, NPS, let's say he went in for the active choice option, right? And allocated 75% to equity, started at the age of 30. Contributed 20,000 rupees per month for the life of the individual, right? Which is right to the age of 60, right? Which is 30 years of investment. And let's assume a conservative compounding rate of 10% per annum, right? Another gentleman starts at the age of 35, right? The difference in the final corpus between the two of them is going to be as high as 80%.
Wow.
For every single year, in this particular example that I spoke about, every single year of delay that you have done between 30 and 35, you've lost 35 lakh rupees. And I've backed out the investment portion from this, right? And, this is not very intuitive, right? I mean, we all talk about power of compounding, but when it comes to actually understanding the impact of this, the impact can be gargantuan, right? I mean, this kind of difference in, final returns, it's 100 and 180. So why would you not start from the first salary? In one of the conversations with the earlier chairman of PFRDA said, the right time to start investing was yesterday, right? If you miss that option, then you should start today, right? And I would completely agree with that. I think from the first salary you started, it's not easy. I understand it, right? I mean, at the age of 25, people are not even thinking about retirement, right? Yeah. But if you can make the small move of saying, let me get some money deducted and let it go to NPS, you're going to thank yourself, 5 years, 10 years from now.
Sriram, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Entirely my pleasure.
I am absolutely thrilled, to have you, because we've never done NPS here.
Equally thrilled to be here. Really, looking forward to this conversation. Anupam.
Let's start, with the absolute basics. Whenever I talk about NPS with people, they kind of blank out. Some of them know it, some of them are kind of reluctant, some of it don't know it at all.
Absolutely.
Because it's not sold or whatever. I just want to start with, what is NPS? Simple question.
So in very simple terms, NPS, as you referred, the National Pension System as it is referred to, was started by the Government of India for government employees in the year 2004. In 2010-11, it got opened up for the unorganized sector, as it is called, or the corporate and retail, which is a non-government sector. So that happened in the year 2010 or 11. And thereafter, for the last 13, 14 years now, NPS as a product is available to non-government employees as well. Now, so therefore, this is a government-promoted retirement corpus accumulation tool in the simplest sense. Now, this is also the cheapest actively managed fund, arguably globally. I don't think there is a cheaper fund available globally, in terms of the fund management charges that are levied. In India, there are 10 pension fund managers as we speak. 3 of them are public sector pension fund managers. The remaining 7 are promoted by different financial institutions, either life insurance companies, banks, or asset management companies. So that, in very simple terms, is NPS.
Now, what I want to understand is that where does this fit in my investment list? In the sense that I've got my mutual funds, I've got my stocks, I've got my debt mutual funds, I've got FDs, I've got everything. Mm-hmm. Okay, but I'm still not clear, how do I even, put this into my portfolio? Where does it fit in? Why should I invest? And stuff like that. So I want to start from the utility case and then build to the tax angle. I don't want to build the tax angle right now. I want to build the utility.
Absolutely. So I think I will talk about 5 key reasons why I think, every Indian should have NPS as a part of his overall portfolio. Not just a retirement portfolio, the overall portfolio. And it is, of course, a retirement product, but I think it is a product that every single Indian should have. And I'll tell you why. Number one is, I told you about the low cost nature of this, this vehicle. The cost here is 1/20th to 1/30th of what comparable actively managed funds charge.
My mind can't wrap around in what's it in bips. But
so in bips, it means between 3 bips to 9 bips, right? So a subscriber here is paying as less as, and even if you include the other costs like custodial fee and so on and so forth, and this was a study which was instituted by the regulator PFRDA, and the finding was that the overall cost through the life of the subscriber in this product is less than 9 bips per annum, right?
Wow.
Compare it to mutual funds, and I'm not for a moment saying that mutual funds, of course, are a product that should find a position in every every person's product portfolio, investment portfolio. But I'm just comparing the fact that this is an actively managed fund which is costing you 9 bips, and here is another actively managed fund which is costing you upwards of 1.5%, right?
Yeah.
So that's the scale of difference. That's number one. So therefore, that in itself has a significant impact on the kind of corpus that you can create. So that's point number one. Point number two is, we spoke about tax advantages, and we'll sort of get into it slightly later, right? Third is, this product offers tremendous flexibility, right? And it offers flexibility to you without any tax or cost implications to switch fund managers within a year, switch across asset classes in the active managed. We'll talk about active managed and active choice and auto choice, but it offers you significant flexibility, right? Fourthly, this is the only product, actively managed product, where the regulators, which is PFRDA, and the NPS trust, which is charged with the responsibility of overseeing the investment management function of the pension fund managers. There is a quarterly review of the performance of the pension fund managers that is conducted by PFRDA and NPS Trust every quarter, which means that the guardrail, and they have set some guardrails in terms of saying you can't go beyond the top 200 stocks when it comes to equity, you can't invest in below, you have to have 75% in at least AA and above, and so on and so forth, right? And government securities, obviously government securities. These are the three categories that we invest in, right? So the guardrails are very strong, and it is monitored very closely. Now, they do not interfere in the fund management decision that a fund manager makes, but the fact is that every quarter, we have to go and report, and there is a formal review that happens with the NPS Trust and the PFRD on the performance of the pension fund manager. I don't think there is any fund which is so closely monitored, because of the fact that, of course, there is a large amount of the money that is invested in this belongs to the government employees, and therefore, and this is a retirement corpus creation tool, so therefore the government is also very, very keen that this gets very closely monitored. Finally, I want to talk about the fact that, all of these 10 pension fund managers that exist today have come with a very strong pedigree, right? So if you look at a combination of all of these 4 or 5 factors, and we'll get into the tax bit slightly later. But if you look at these 5 or 6, and there's one very beautiful feature which I will talk about, later, in terms of why I think, this is, such a brilliant product and brilliantly designed product, in my opinion, right? So if you look at these 5 reasons, this should really make a very strong case for, the cost and, all of the other factors that I spoke about. Really makes a very strong case for having this in your, beyond just the tax advantage bit, right? I will talk about tax advantage, but that's the reason why.
Let's go into that.
So on the tax side, Amit, Anupam, sorry.
I know. That's a hat tip to something that we'll get onto later in the show, but go on. Yeah.
So, on the tax bit, there are 2 parts to it, right? So there is, this product is understood as the product which is that 50,000 rupee product, right? I put in 50,000 rupees. What's the big deal? I may save 16,000-17,000. What's the big deal, right? So I want to bust some myths on this, right? So number one, it is not 50,000. Of course, it is 50,000 because this is the only product, right, where it's under it's section 80. I don't want to, bore your listeners with the section of the income tax, but under 80CCD 1B, there is a 50,000 rupee dispensation that is available only for national pension system. There is no other product that can qualify there. So there's an incremental 50,000 that is there. The base 80C, 1.5 lakhs is something that you can use by investing in NPS as well. So for a normal, let's say, self-employed individual, you have a total of 2 lakh rupees that you can invest in NPS in a year, in every single year, right? So this is for the retail investor, the unorganized sector, so to say, right? Now for the corporate sector, which is for a salaried employee, I think the advantage is tremendous, right? And if you take the new tax regime or old tax regime, this benefit is available irrespective of whether in the new tax regime or the old tax regime, right? This section, under section 80CCD2, again, not wanting to get into semantics, but under this section, up to 10% of your basic or basic plus DA, as the case may be, you can actually have this deducted as an employer contribution into NPS, which means that, let's say, for example, somebody is at a, 1 lakh rupee basic, right? Or a 50,000 basic, whatever be the example, right? Up to 10% can get invested. You are saving tax on the entire contribution that you're making, which means that right from the word get-go, you're actually making 30% return from the first contribution itself.
Because that entire chunk goes off my income.
Exactly. It goes off your income, and therefore you're not paying tax on it, right? And then on top of that, all the other stuff that we spoke about in terms of the low cost, in terms of the fact that, so it's a brilliant.
There was a small loophole which has been closed because we had done an episode like many years ago. I forgot with my very good friend Mahesh, and he explained how that was. I mean, this exact same thing that you said is what we have covered in the past.
Right.
It was a bit of a window that was open for higher earners to keep on putting money.
Correct.
What's the limit now there?
So the limit now is 7.5 lakh rupees. So there are three contributions that get accounted for there. So there is contribution that's made by the employer to NPS. There is contribution that's made by the employer to EPF, Employee Provident Fund, and the contribution that is made to superannuation wherever it is applicable. Superannuation is hardly there. Very few companies have a superannuation. So between Employee Provident Fund and this, the total cap is 7.5 lakhs. But I will argue very strongly that you should actually cap your EPF contributions to only 2.5 lakhs because employee contribution on beyond 2.5 lakhs gets charged, right? The interest gets charged at marginal rate, right? So there's a very strong case for you to cap your EPF contribution and actually max out on your NPS contribution. So because under the 7.5 lakh umbrella, you can still maximize the amount of tax savings and therefore the kind of investment that you can make.
Sure. I want to just get into the whole exempt tax thing which is there. I think for NPS, in comparison, EPF is still exempt.
That's correct.
Right? So what does this mean and how would you explain this?
So the way I would look at it, I think the way it is perceived, right? So if you look at NPS and if you look at EPF is very well understood because people have been in EPF for ages now. Yeah. It is an EE product. So whatever you contribute, of course, within these limits, we spoke about the 2.5 limits, which is the employee contribution. Beyond 2.5 lakhs is now, it goes into a separate account and it gets charged to tax.
Even for Employee Provident Fund.
Employee Provident Fund, right? So it is not, in that sense, a truly EEE product.
Correct. But for the vast majority who are below?
Below 2.5 lakhs, yes, it is a EE product. Now, when it comes to NPS also within this same, the 7.5 lakh cap that we spoke about, it is an EEE product. Now, it is perceived as an EET product because the requirement is that on maturity, the corpus that you get, you have to buy an annuity product with 40% out of that. So, if your corpus that you accumulate is, let's say, 25 lakhs or 50 lakhs, right? 40% of that has to be used for purchasing an annuity. Now, income that you make from annuity is obviously chargeable to tax. Now, the argument is that, is the 100 tax-free? Of course, it is tax-free, right? 60 comes to you in the form of a lump sum where you're not paying any tax. The remaining 40 is also tax-free. Right? Any product that you invest into at that point of time is going to, whatever gains you're going to make from that or interest that you're going to accrue from that is going to be charged to tax. So to that extent, the maturity is also completely exempt from tax. It's just a perception that, since I have to buy an annuity, since the pension is taxable, therefore this is EET. It is not EET. It is actually triple E. Right? It is as good as, EPF in terms of its. And the beauty is that it is market linked, it is transparent, it is, you know where you're investing, right up to the last rupee, you know where the money is going, right? So I think very, very strong reason why you should, max out on this.
Okay, so we've done tax benefits. I want to just understand how it's such a compelling retirement accumulation product because I want to just explain to our listeners how retirement planning works. Okay, so you've got two phases in retirement. One is called accumulation, one is called distribution. Accumulation is when you're slogging and you're earning and you're putting your money into that corpus, which could be from the age of 25 to say 65. That's 40 years of your working life. That phase is called retirement accumulation. Okay, you're earning, investing. And because at the age of 65, you chill out in life. Sab kuch chill, you're done with everything. Yeah. That's called the distribution phase. Okay, so NPS is a very compelling accumulation product and I want to understand why.
Okay, so I spoke about all the benefits around the cost and this, that and the other, but I'm going to talk about two features of this brilliant product which makes it shine, right? Number one is that you can't get out of this product at the time of accumulation. Now this gets perceived as a shortcoming, right? Everybody says, "Arey boss, isme paisa, I'm going to
locked in hai,
paisa phas jata hai." But my question is, and Anupam, you know this, you're an expert. You've been doing this for a while. There is a difference between investment return and investor return, right?
Always.
More often than not, investor returns are nothing compared to what the investment product returns are. Why does that happen? It happens because people get in and get out, right? Because there is the GFC, then there is the, there's the tech, whatever, right? There are various reasons. There's so much of noise. People get in, get out, right? So while a product may have delivered 20% compounded over the last 25 years, the investor return would not be anywhere close to that, right? Because of this reason of noise and therefore our proclivity to act based on this noise, right? This product doesn't allow you to get out, right? And therefore, if you look at if you compare the investment return and the investor return for somebody who's been in this product, let's say for 10 years, they will be exactly the same, right? Because you don't have a choice of getting out, which in my opinion is the most positive feature about this product. You can't get out of this product,
There's
right?
literally no feature that says redemption.
There is no
you
redemption.
You have to just stick with it.
You can get out. There are some limited, windows that 25% of your contribution and so on and so
like
forth.
It is for PF. Yeah.
Like it is for PF, right? But it's as good as nothing, right? And therefore, that in itself will make sure that you will willy-nilly make double-digit return if you have the right kind of allocation, which means that it's going to create magic for you. On maturity, right? Which people will not realize in the short term. And as we all know, the compounding engine starts kicking in beyond 15, 17 years, right? And I think that's a brilliant feature. That's one, right? Yeah. No other product offers this. And and you know what is happening. It is not as if it has gone into a black box and you don't know what's happening. You're hoping that some returns come out. You know exactly what's happening, right? Number two, it offers this, out of the two choices, the auto choice and the active choice. And we'll, of course, can cover this later as well. But if you look at the auto choice option, right? Now, all of us in investing keep talking about asset allocation rebalancing, right? How many of us are able to do it in reality? Right?
It's a pain,
right? Yeah. Now, this auto choice option actually automates your asset allocation and rebalancing, which means that as you get closer to retirement, which is your age of 60 or 58 as the case may be, the allocation to equity will keep dropping. So let's say, for example, you chose an aggressive option, LC lifestyle, life stage 75 it's called the aggressive option, where 75% of the money goes towards equity. Now, every year, starting from the age of 35, the allocation to equity will keep dropping to 15% at the age of 55, which means that every year there's a reduction of roughly 3% to equity, which means that on an automatic, you're not doing anything. You're contributing on a monthly basis or on a yearly basis, or whichever the case may be. But the product is automatically rebalancing, which is such a brilliant feature, which you're not able to do it on your own, because there are a lot of behavioral biases that we suffer from, right? If the markets have gone up and if it's looking very good, you said, no, let's keep it there. It'll go up further, right? This product will do it, and it'll not ask you. It'll do it on its own, right? So this is the second feature, which I think, other than all, over and above all the other stuff that we spoke about, these are two brilliant features which makes it ideal for retirement planning. Risk management along the journey, and making sure that you can't get out. And therefore, your investor return will be equal to the investment return.
Yeah. I mean, you don't get that in other products. I'm kind of done with the part about explaining what NPS is, and I'm going to just go into the part about how it works. Sure. Is there even a right age to enroll for NPS? I know that I'm late, but that's because, I haven't had a salary job for a very long period of time. Sure. But if I had, then I would have done this. I got in too late. I'm 51 right now.
Right.
Okay. I thought I'm ideal any which way.
Right.
Okay. Right. But other than me, who do you think, what's the right age to get into this?
So I'm going to talk about, again, I'm going to use some numbers, and I don't want to sort of, make it very confusing, right? If you look at somebody who started investing in, let's say, NPS, let's say he went in for the active choice option, right? And allocated 75% to equity, started at the age of 30. Contributed 20,000 rupees per month for the life of the individual, right? Which is right to the age of 60, right? Which is 30 years of investment. And let's assume a conservative compounding rate of 10% per annum, right? Another gentleman starts at the age of 35, right? The difference in the final corpus between the two of them is going to be as high as 80%.
Wow.
For every single year, in this particular example that I spoke about, every single year of delay that you have done between 30 and 35, you've lost 35 lakh rupees. And I've backed out the investment portion from this, right? And, this is not very intuitive, right? I mean, we all talk about power of compounding, but when it comes to actually understanding the impact of this, the impact can be gargantuan, right? I mean, this kind of difference in, final returns, it's 100 and 180. So why would you not start from the first salary? In one of the conversations with the earlier chairman of PFRDA, he said the right time to start investing was yesterday, right? If you miss that option, then you should start today, right? And I would completely agree with that. I think from the first salary you started, it's not easy. I understand it, right? I mean, at the age of 25, people are not even thinking about retirement, right? Yeah. But if you can make the small move of saying, let me get some money deducted and let it go to NPS, you're going to thank yourself, 5 years, 10 years from now.
They did such a great job in SIP.
Yeah, absolutely.
We've
absolutely.
reached from literally zero.
Zero,
10, 20 years ago, this number was actually zero.
Exactly
So now
right.
it's like some almost, in a short while, it's going to hit 2 billion a month.
Absolutely.
That itself is progress.
Absolutely.
I'm just wondering, people, if you're listening, please consider this also.
Absolutely.
Opening this account is insanely simple.
It's a breeze, yeah.
I have done it, and it's like, even I was surprised.
Yeah.
I thought sarkari hai to time lagega,
Yeah,
etc.,
it's a
but
breeze.
it just kind of took me less than 5 minutes.
Yeah.
Sriram, let's get into the details, okay? Because when you sign up for this, I recall because I was doing this when I was doing this, it's insanely simple.
Yeah.
Okay. And there are two very important choices.
Sure.
Actually, let me take a step back and talk about sign up. Because sign up also has some POP or some stuff out there.
Yes.
Can we just understand that? Because that, I think, has some cost implications also.
Yes. So I'll try and explain this to you, and I think this is not very widely understood, and rightly so. I don't think we've done a very good job of explaining the whole architecture to the people at large, right? So there are multiple players in the ecosystem, but I'll just focus on the ones that are material to the subscriber, right? So the first choice that one needs to make is, where do you get the account opened from? Who do you get it opened through, right? So you could walk into your neighborhood bank branch and get it opened through them. Irrespective of whether you have an account with them or not, you can. All banks, by and large, are points of presence, right? What are points of presence? These are people who are authorized by the regulator to help the subscriber open an NPS account, right? So the POP community is, 90 odd strong at this point of time. Most banks are POPs. A number of broking entities are also POPs. Almost quite a few of the pension fund managers are also POP. But HDFC Pension has been a POP now for the last 3 years and is today the second largest corporate NPS POP subscriber, and in terms of number of subscribers and number of corporates and so on and so forth. So this is the POP. So the POP is the entity which helps you open the account. You could do it online.
Which is what I did. Yeah.
All banks offer an online capability. If you are already a bank customer, then your KYC is already done, right? And therefore, the process of opening an NPS account is as quick as 3 to 4 minutes, right? I mean, the PRAN, as it is called, the Permanent Retirement Account Number, gets generated within 5 minutes, right? If you're not a bank customer, if you go through, let's say, an HDFC Pension website, we do not have your KYC details. So we would want you to go through either the CKYC framework or the Aadhaar framework, which again is a breeze because it's a OTP-based process, and within 5 minutes you'll be able to get your account opened. So that's the POP part of it. The other choice that you need to make is, so once you get your account opened, you need to make a choice of who will be your pension fund manager.
I just want to go back on the POP part, the costing thing.
The cost is fairly marginal. In fact, the account opening cost for a retail investor is 400 rupees, right? So there are 2 or 3 types of charges that are there. So there is a 400 rupee charge for account opening. There is a charge which is levied at the time of contribution. So every time you contribute, there is a small fee that is levied, which is 0.5%. It is capped at 5,000 rupees. So it's not a very large charge. Then on exit, there are some charges. That's again is between 125 rupees and 5,000 rupees. It's a very low cost. So the way the whole structure has been created, the government has been very cognizant of the fact that this is something which needs to be widely adopted by people, and therefore the cost structure is very low, right?
Got it.
So that's the only cost that you pay at the time of account opening, right?
Okay.
And then you make the choice of so that's the cost element.
Let's get to that. Yeah.
The pension fund manager. So the pension fund manager, as I mentioned earlier, there are 10 pension fund managers at this point of time in the country, and out of which 3 of them are PSU pension fund managers who you predominantly manage government employee contributions, because by default the money from government employee contribution, government as well as the employee contribution goes to them.
Sure.
So they manage a large chunk of the government employee money, right? The private sector pension fund managers, we are one of them. In fact, we are the largest, right? As we speak, we've crossed 50,000 crores of assets under management.
Oh, okay.
Right? And we have over 15 lakh subscribers with us. So you make a choice of the pension fund managers, and and there are, as I said, there are 10 pension fund managers that you can choose from. There is an 11th one which has got empaneled, and I think they will start operations the next quarter or so. So that's the other choice that you need to make.
That call I'll have to take on my own.
Yes, that call you take on your own.
Yeah, that's what.
That call you take on your own, basis your comfort, basis your analysis, and we can get into what are the things that you should look at. But those are the 2 things, right? One is the POP and the second is the PFM.
Sure.
There is a CRA, which is the Central Record Keeping Agency. There are 3 CRAs at this point of time. There is Protean, there is K-Fintech, and there is SCAMS. These are the 3 CRAs which basically take care of the back end.
Protean is old NSDL. I think.
That's correct, old NSDL, right? So all of them essentially look after. So you choose one of these during the course course of the account opening, it really doesn't matter. The costs are the same, very marginal cost again. But they will essentially help execute all your service requests, which goes through your POP. So your POP is your window to the NPS account, right? They are expected to take care of all your service requests. Everything resides with the CRA. The CRA would process it for you, but POP is the window to your...
CRA literally stands for Central Record Keeping Authority or Agency. I don't know which one.
That's correct.
So their role is not as much as compared to the POP. POP is your point of presence, point of contact.
Is your window to the NPS account. Yeah.
Please go on.
Yeah, so that's so these are the three entities that are material. There is a trustee bank and there is a custodian and so on and so forth.
But that's
those
like any normal investment.
So those are not material to. You don't need to know about all of those things. But these three entities, I think, are important, and therefore, that's the ecosystem that one really looks at.
I went through a POP. I've chosen a PFM. It's basically that I've used a point of presence, and I've now that I have a pension fund manager.
Right.
Now comes the big choice for me.
Right.
Okay, which is what's it called? It's called active or auto, is it?
Yeah. So there are two choices that you can make. So there are two options that a subscriber has. The first choice is the active choice. Not the first. So there are two choices. Essentially, the active choice option and the auto choice option. As the name suggests, the auto choice option is the one where there is an automatic rebalancing that happens between the three underlying categories of investments. There are three categories of investments in NPS. There are four actually, but we'll talk about equity, corporate bonds, government securities, and there is something called A, which is alternate assets, but that's an insignificant part of the overall thing, so I'll ignore that for now. So under the auto choice option, in fact, A is not available in auto choice option. You can actually invest in a combination of E, C, and G, right? So under the auto choice option, what happens is that you can choose between three options within auto choice, right? There is a conservative option, which is called as LC25. There is a moderate option, which is called as LC50. And then there's an aggressive option, which is called as LC75. What the 25, 50, and 75 suggests is the amount of money that is going towards equity as an asset class. So if you're a conservative investor, you want to take a lower, allocation to equity, 25% will go into equity and 50 and so on and so 50 and 75. Now, this is true till the age of 35. From the age of 35 till the age of 55, the allocation towards equity will automatically keep getting rebalanced every single year on the birth date of the individual subscriber. You'll get reset by 3%, 2% or 1% as the case may be, and bring it down to 15% in the case of aggressive, 10% in the case of moderate, and 5% in the case of conservative at the age of 55, which means that as you have reached closer to your retirement age, your allocation to equity has actually come down quite significantly, and therefore the risk of volatility, which is the problem with equity in the short term, goes away completely or almost goes away, and therefore you basically reaped all the rewards of large equity allocation at early stages in life, and you've got to a reasonable kitty at that point. That's the auto choice option. An auto choice option is ideally suited for those who want a fill it, shut it, forget it approach, right? So they don't want to keep tinkering with the asset allocation. They don't want to make changes. You can still make changes in pension fund manager twice in a year, right? But as far as the allocation to the three asset classes are concerned, they don't want to tinker. They say, I just want to put it in and let it do its own thing, right? Let it work its magic, right? So that's the auto choice option. The second is the active choice option. So a lot of us, believe that we understand investing, right? And that's true for a fair number of people. They would then want to take a call on what should be the allocation to equity, what should be the allocation to GSEC, and what should be the allocation to corporate bonds, right? And there, the investor is free to choose up to 75% in equity, and the remaining 25% can be in corporate bonds and government securities. You can actually have 100% government securities also, right? And you can keep switching. 4 times in a year, you can keep moving between these three asset classes, 4 asset classes actually, and without paying any cost, without any tax.
Through my life cycle?
Through your life cycle.
Wow.
Right? Okay. Right up to, and there is no compulsion on you to get out of this product at the age of 60. You can hold on to it till the age of 75. Right? And have a 75% allocation to equity till the age of 75.
Oh, so the annuity part is my choice.
The annuity part, so when you annuitize is your choice.
Oh, I didn't know that.
Right?
I thought it happens automatically.
No, you can actually hold on to it. You can say, okay, I want this compounding engine to continue to fire for the next 5 years. I don't need money. I might probably need some at the age of 65. Let it continue to fire. And annuitize at the age of 65, 40% of the corpus, and and so on and so forth.
But the minimum age is 65.
The minimum age is 60.
60. Okay. So anytime after 60, I can press a button and go for an annuity.
You can.
Okay. So we've done auto, we've done active, and I've kind of let me use my example.
Yeah.
So my POP is K Fintech,
Right.
of course.
Right.
My fund manager is sitting in front of
So
me.
glad to hear that.
No, of course, come on. It's very rare that I have my fund manager sitting in front of me, but there you are. My fund manager is HDFC Pension Management Company, and I chose the auto thing. I exactly what you said. Fill it, share it, forget it.
Right.
I don't want to get into all this. Okay.
Right.
What I see is, so I'm 51, right, and I started this a couple of years ago. I saw ES kind of come down. Last I checked, and I don't even check my statement.
Right.
Honestly, I just do not check my
Yes.
statement. It keeps on coming every month.
The ideal investor.
But I mean, why should I check?
Exactly.
That's the reason why this is there.
Exactly.
If I recall correctly, the E part is 19%. So it's called E, C, and G.
That's correct.
E for equities,
C
C for
corporate
corporate bonds, and G for GSECs.
GSECs,
Right. So
that's
those are
correct.
the three segments that you
That's
guys
correct.
invest in.
That's correct.
And every month there are some charges which keep on coming and going, and that's also quite transparent.
Yeah. Very, very transparent.
I mean, that's actually, and they, like any, I think, insurance product or whatever, it goes from the number of units that you have.
That's correct. And it is insignificant.
Yeah.
Anupam, it's insignificant. In fact, the custody charges are as low as 60 rupees a year or something like that. So it's a
60
fraction.
rupees a year.
Something like that, right?
Irrespective of my corpus.
Irrespective of the corpus. It's a very insignificant amount. So I think contribution pay, there is a percentage charge which is there, which again is capped, as I told you. So the cost structure is actually very, 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 very low.
I just love that statement. It's got it's so transparent.
Yeah.
It gives me X IRR here.
Absolutely.
When I look at that,
Exactly.
and I posted it on my Twitter account so many times that I'm not doing anything out here.
Yeah,
I'm literally not thinking.
Absolutely.
And this is giving me an X IRR of some 8-9% when the market was flat, etc.,
Yeah,
etc. And I'm,
Yeah.
I don't want to be concerned with all of that, So, we've covered active, we've covered auto. Okay, Sriram, I'm just kind of winding down this episode, and there's obviously, I think the biggest question to someone who is just opening an account is which fund manager do I choose? When it comes to active or auto, I can, that depends entirely on personalities.
That's correct.
People have their own confidence. Please choose your thing. Someone like me will, just go for auto without even thinking.
Sure.
How do I choose a fund manager out here? I mean, do the same rules of mutual fund apply, or is it something different here?
I would say that broadly the same metrics that you use to evaluate a mutual fund manager would apply here as well. But given the fact that here this is all about your retirement kitty, which means that this entity needs to be around, alive and kicking, and I'm not for a moment suggesting that they won't be, because each of them are regulated by PFRD and well capitalized and so on and so forth. It is important for you to know as a subscriber this is a very low cost product, and therefore what happens is that size and scale gives the fund manager ability to invest in fund management capabilities or other things that you may want, like for example a research team, right?
Correct.
So today HDFC Pension Fund Management Company, out of all the private sector pension fund managers, has the largest front office team, right?
Okay.
In terms of research folks and in terms of course the the fund managers and the dealers and so on and so forth, right? We are able to do that because despite the fact that the margins are very slim, we've now crossed 50,000 crores of assets under management, right? Now, so therefore it is important for you to align with a pension fund manager which has got size and scale on its side. And interestingly, the moment we cross 50,000 crores, we start making lesser, right? Up to 50,000 crores, we make 6 paisa. Beyond 50,000 crores, we may start making 5 paisa. So what happens is that as the size grows, the effective cost for the investor or subscriber also keeps coming down as we become bigger.
Regulated by the government.
Regulated by the government, right? So therefore it gets cheaper and cheaper for you, right?
Yeah.
That's number one. Number two, I think you need to be fundamentally aligned to the the philosophy of the fund management team. And I'll tell you, PFRD has made it so transparent that you can actually get into each of the pension fund managers' website and you will be able to see right till the last penny where the money is getting invested, the constituents of the investment committee. So I think what it requires is for you to have comfort with the entity, and you need to have the confidence that they will be able to last this lifetime of 20, 25, 30, 35 years that you have, at the end of which you are hoping to, get this money, and, it should be in a reasonable shape, right? For HDFC Pension, I think all of these things are material. I mean, we are promoted by HDFC Life. HDFC Life is the sponsor company. They themselves manage 2.4 lakh crores of assets under management as an insurance company. Within the group, of course, there is HDFC Asset Management Company, and then there is HDFC Pension Fund Management Company. So there is a lot of investment management experience within the group. So our ability to draw upon the investment management experience within the group is significant. We have gained size and scale. And that's because of the fact that we are at the top of the charts when it comes to, ECG. If you look at since inception performance across all of these three asset classes, our since inception is close to 10 years now. We're right at the top, right? Look at 5-year, 7-year, 9-year performance of all the pension fund managers. We're right at the top number 1 or number 2. Now, not for a moment am I suggesting that this will change. Of course, it will change, right? Because, performance will go through cycles. The point I'm making is that you need to align yourself with somebody who gives you comfort, right? Somebody who you think will be around for the next 25, 30 years. And I think there's a very strong reason that HDFC has been as a group around for the last 47 years now, and there's no reason why. And we are committed to the retirement business. The sponsor is committed to the retirement business. So there is no finish line, as our chairman says, right? As far as this business is concerned.
Yeah, and pensions are sensitive. I mean, there are globally, I think there are a lot of countries which have seen rights for pensions and stuff like that.
Absolutely. France very recently.
There you go. So, if the listeners out there are wondering why we're going into this, it's because your pension is your very hard-earned money. And believe me, you want it locked in and safe and secured with the right person. And especially when the government kept this closed for a reason.
That's
the longest time it was closed, and now that it's open.
That's correct.
So the choice of fund manager is obviously going to be very important for you. You also do work on the government. Now the government employees can also invest.
Yes.
I mean, how does that work?
Central government employees can now choose a non-default option. So the default option is 15% goes to equity, 85% goes to GSEC and corporate GSEC actually, and it goes equally to the 3 PSU pension fund managers. That's the default option.
Sure.
Now in 2019, central government opened it up for all central government employees that you can choose a non-PSU pension fund manager also, and a non-default scheme option also. For a government employee, so LC25, which is the auto choice. So active choice is not open to them yet. Auto choice 25, which is 25% allocation to equity, and auto choice 50 is available to them. So both these options are available to a government employee. So we work extensively with, various government departments, central government departments like postal, railways, where there is a very large universe of, and paramilitary, home affairs, which are large number of employees, on the central government side. And we run a number of retirement awareness and NPS awareness seminars.
Nice.
The thing is that, this is not just true for the government employee, but this is true for 8 out of 10 people that I meet, right? The awareness around this product is abysmally low. And in the government setup, what happens is the government is the employee is putting in 10% of the basic plus DA. The government is contributing 14%, right? So there's a 24% getting into this every month, right? So it's a reasonably large amount. There is no PF there, right? So this is and the employee needs to realize that if only 15% of this is going towards equity, then the chances of this over even a 25-year time horizon delivering more than 7.5% is very low, right?
Yeah.
So therefore, we work with these government and the government, I must tell you that the hierarchy in the government is very supportive, right? I mean, I was in Delhi a couple of days back, met with a few senior folks in the postal department, secretary level. More than happy to, help us in running these awareness sessions, right?
How about that?
We're cognizant of the fact that, we talk about NPS as a product and what are the options available to them. So in the last year plus, we've now been able to attract over 1 lakh government, close to 1 lakh government subscribers to choose HDFC Pension Fund Manager as their preferred pension fund manager out of their default scheme. So that's what has happened.
I mean, I don't usually recommend, and I'm not now, I guess SEBI will also put in a rule out there that as a podcast host, I can't even recommend anything, but folks, I can talk from my own personal experience. I am super duper happy with this product, and honestly, Sriram, I've not invested it for tax. Okay,
right,
tax to me is the last consideration.
Absolutely.
Because as I don't know, was it the Bible? The Lord giveth and the Lord taketh away. I think we've seen enough of this to say that tax aaj hai, kal nahi. Who knows? Honestly, I'm just doing this for the merit of it.
Absolutely,
because there's just such a compelling case for doing this, and whoever I meet, I tweet also about it. I just tell them, at least consider this.
Absolutely.
And I'm also thrilled about the fact that the government on their side, I think they started universal healthcare, both life and health. General, both some time back, for pretty much everyone.
That's right.
So people, these days come up so much time that they want to open something for their domestic health.
Right.
Maid ke liye karna hai, driver ke liye karna hai. I'm like, dude, they'll figure their bank account.
Yeah.
Have you even looked at investments here, and before jumping into the whole SIP bandwagon, at least consider this.
Absolutely.
I mean, these people should be looking, they should be aggressively looking at retirement products.
Absolutely.
And securing the future. So folks, if you're listening into this, you should really look into this, not only for yourself, but for pretty much everyone else.
There's one other thing that I want to talk about, which is referred to as the Tier 2 account, right? Now, we use a lot of jargons.
Yeah. I forgot this completely. Yeah. Tier 1, Tier 2. So Tier 1 is a taxation part.
That's correct. Yeah.
Tier 2 is the funky part.
That's correct. So, and this is not very well known, right? This again is a very small part of the overall.
I have a Tier 2.
Oh, fantastic.
But honestly, when I'm on the first page of the statement. I don't even think I reached till the last page. But please tell us what's tier 1, tier 2.
I think it's a very interesting option, right?
How did you miss it? Amazing.
Yeah,
Okay.
so, tier 1 is all the tax advantage that we spoke about, ATCCD and so on and so forth. Tier 2 is nothing but a simple, active, low-cost, actively managed alternative to a mutual fund, right?
Wow.
So you're getting and you could go 100% in equity there.
There you can just freak out.
You can just
do
go
whatever you
100% in
want.
equity
And
and
there's
you
liquidity.
can use this
You
100%.
can buy today, sell tomorrow, do whatever you want.
Absolute liquidity, right? Full liquidity. Now, also from a tax angle, right? I mean, and I can't comment on the tax angle because it's a matter of interpretation. But one thing is very clear, right? So you continue to accumulate money in tier 2, let's say through your lifetime. You continue to just keep putting money there. You could use it as a parking vehicle, or you could create it as a wealth management tool as well, right? You continue to, let's say, park some money there outside of the tax advantage. And over, let's say, a 15, 20 year, and as you get closer to your superannuation age, you can actually move money from tier 2 to tier 1 time. Once in your...
I didn't know that.
You can do that. And whatever corpus, so therefore it becomes a part of the tier 1 corpus, which means that 60% of that comes to you tax-free, right?
Amazing.
And the remaining 40% you have to annuitize.
Let me go back to that again. When does this happen? When do I get the option of tier 2 to tier 1?
Once in your lifetime.
Oh.
And you would do that closest to your
retirement
or when you're planning to take the money out.
You've given us a pretty big hack.
Yeah.
I hope that it's not closed by the government.
No, it is available and because there is also money that moves in from superannuation to tier 1, because a number of companies which had a superannuation account have now chosen to move out of superannuation to NPS because it's far less cumbersome, right, from that perspective.
Tier 2 is giving me active management at a cost lower than even index funds.
Absolutely right. Absolutely
Guys,
right.
I mean, I think I should look at increasing my tier 2 allocation. That's the thing, Sriram. I just forget about this. The whole, the fill it, shut it, forget it part, the forget is what kind of hits me. But an SIP to NPS is just such a simple hack.
Absolutely.
It is something that can help a lot of people do a lot of things. But we are done with the heavy duty part of the show, Sriram. Now I want to get to the chilled part, okay?
Sure.
As we were talking before this recording started, you're like heavily into podcasts.
That's
okay,
correct.
Just give us maybe 3 or 5 recommendations. And if at all you do books, I would be happy to have that also.
Love to do this, Anupam.
Go on, please.
You are one of the people that I follow, Anupam, and I must tell you that you've done a fantastic job of and shining the light on so many varied topics, right? With a friend of mine very recently, Vartana.
Yeah.
So I've heard
Brajesh was here.
Is a very dear friend from college days, right? Very
Is
close.
that right?
Yes, that's right.
Yeah,
And I was so fascinated when he said, I did a show with, and it got dropped, I think a few weeks back, and fascinating, right? So it's a eclectic bunch of topics that you cover. Very, very interesting. So you're certainly one of the people that I would recommend very strongly. Then there are a bunch of podcasts that I listen to. Indian, which is Amit Verma being one of them. He's also an ex-IVM podcast guy.
Now people get the Amit reference which happened earlier in the episode. Okay, so Amit Verma is done. Okay.
So, I listen to some of them because they're all 5 hours, 6 hours, 7 hours, and I like the style and I like the depth that he goes into, and it's fun, right? Then there are, a few podcasts. Well, Morgan Housel has now started a podcast, if you know, right? Finally.
Yeah.
So which is again short ones, 15, 20 minutes, but very interesting, very compelling.
Sure.
Jim O'Shaughnessy, Patrick O'Shaughnessy, Invest Like the Best is brilliant.
Yeah.
Again, they get some really, really good guys on the show. And then there is some, very interesting stuff that News Laundry does. I don't know if you're aware, but they do some really, really good stuff in terms of independent news reporting, right? Yeah. So there are a whole host of these. I mean, as I said, I consume a lot of my time goes into listening to podcasts, and of course Audible as well. I mean, audiobooks are easier to consume now, so that's the other thing that I do. So that's podcasts, and there are a whole list of ones that I can give, but I don't want to go beyond this. Books, I think one book which really sort of made me think very deeply was Atomic Habits by James Clear, right? I mean, it's a brilliant book. Right.
You've not had that on the show for quite some time.
So
I was wondering why nobody's done it. But lovely. Great.
It's a brilliant book because it gives you some very simple hacks, right? It teaches you some very basic things that can help you break out of bad habits or get into good habits, right? Very interesting book. And of course, when it comes to investing, there is of course the all-time favorite, right? Morgan Housel's Psychology of Money.
Sure.
And I'm sure multiple people have spoken about this.
They have indeed.
It is such a brilliant book, right? Any page that you open, there is wisdom in there, right? And he's writing another book, I'm told. So, I'm really looking forward to that. Ben Carlson's Wealth of Common Sense, right? I mean, it is again such a fascinatingly beautiful book, right? I think so. Investing, these are the kind of books that I really, really like. There's one very, it's a Hatke kind of a book. I think he's a very popular guy. I stumbled upon him somewhere. A guy called Amor Towles, right? And the book is called Gentleman in Moscow. You should read that book. That book talks about somebody from the royal family in Russia, pre the Russian Revolution, and how he navigates through the time of having been a royal, being courted, and then, sort of living through that journey of communism.
Yeah.
It's a brilliantly written book.
Name an author again, please.
Amor Towles, Amortowles, right?
And the book
is called A Gentleman in Moscow.
Wow.
Right?
How about that?
Brilliant book, right?
Okay.
And, so there are so many of these, and I try and pick up things which are outside of my domain, and there's one other book. I'm sorry, I'm doing
please,
an overload
please.
of this.
We love recommendations.
There is this book on math, right? And for a moment, I've sort of blanked out, but it's a book about how do you, making numbers count.
Oh, yeah, of course,
right?
of course.
Well, it's a brilliant book, right? Again, very, very, simple, how do you make...
I got Making Numbers Count by Tim Harford, the undercover economist.
Yes,
I have that.
Oh, yeah.
And it just relates numbers so easily to you.
Right? And how do you make numbers interesting for people, right?
Yeah.
So all of this, I mean, it's fun, sort of listening to podcasts, Audible, reading as much as you can. It's just fun.
Wow, folks. So, a long episode, but then it was totally worth it because we got tons of information on a product that, you should definitely look at. And of course, so many recommendations on podcasts and books. But that is it. That is a wrap on this really special episode of Paisa Vaisa. My guest, Sriram Iyer, CEO, HDFC Pension Management Company. Sriram, thank you for doing this episode, for explaining NPS to us, and of course for the wonderful list of recommendations. Thank you.
Thank you. It's been such a privilege and a pleasure.
Thank you so much.
Thank you.
Thank you.
IVM